The historical record of the 1929 Great Depression serves as a critical blueprint for understanding systemic financial failure and institutional resilience. During the period between 1930 and 1933, approximately 9,000 American banks failed, leading to the complete evaporation of depositor wealth. This catastrophic collapse was not a uniform event across all financial institutions, as certain structures proved significantly more robust than others. The conventional narrative often focuses on the desperation of the era. Yet a specific category of savers remained entirely intact through the crisis. These individuals did not rely on personal connections or immense wealth, but rather utilized a government-backed savings structure that expanded by 800% during the economic downturn. The disparity in survival rates between different types of institutions reveals that structural design is more important than brand recognition during a crisis. Commercial banks in 1929 operated with a profit motive that incentivized aggressive lending practices and speculative investments. These institutions frequently funneled depositor funds into call loans for stock market investors and high-yield corporate bonds. When the market crashed, the underlying assets of these commercial banks vanished, taking depositor savings with them. In stark contrast, mutual savings banks in states like Massachusetts, New York, and Connecticut maintained a remarkably different trajectory. These entities were legally structured to prioritize depositors over shareholders, as they lacked a traditional profit motive. State regulations mandated that mutual savings banks invest primarily in conservative assets, such as short-term mortgages, rather than Wall Street speculation. While over 40% of commercial banks across the United States failed during the early 1930s, the vast majority of New England's mutual savings banks remained operational. The modern financial landscape in 2026 offers similar structural distinctions that are often overlooked by the mainstream personal finance industry. Credit unions function today under a model nearly identical to the historical mutual savings banks, being owned by members rather than external shareholders. A critical component of this resilience is the separation of insurance frameworks between different institutional levels. Commercial banks are insured by the Federal Deposit Insurance Corporation, FDIC, while credit unions fall under the National Credit Union Administration, NCUA. Holding deposits in both types of institutions does not merely double insurance coverage, but places capital within two entirely different legal and regulatory frameworks. This diversification across insurance pools provides a secondary layer of protection against localized or systemic institutional failure. However, the most significant historical strategy for absolute capital preservation involved the removal of intermediaries altogether. The United States Postal Savings System, established by Congress in 1910, allowed citizens to deposit funds directly at any post office. This system was not backed by a private insurance fund, but by the full faith and credit of the United States government directly. By 1929, the system held a modest $153 million, primarily serving rural workers and immigrants who harbored distrust toward commercial banks. As the banking crisis intensified, deposits in the postal system exploded to $2 billion by 1934, representing an 800% increase in just 5 years. Savers were not attracted by high interest rates, as the system offered a deliberate 2% annual return to avoid direct competition with private banks. The primary motivation for this migration of capital was the guarantee that not a single cent would be lost to institutional insolvency. Despite its success during the Great Depression, the postal savings system was abolished in 1967, following decades of lobbying by the banking industry. The existence of a government-run deposit system that outperformed private banks during crises was viewed as an unwelcome rebuke to the banking sector. In the modern era, the functional equivalent of this system exists in the form of Treasury Direct, operated by the United States Treasury Department. Treasury Direct allows citizens to bypass banks and brokers to purchase Treasury securities directly from the federal government. Financial instruments such as Treasury bills, T-bills, notice, and bonds are held in accounts registered directly with the Treasury itself. When an individual purchases a T-bill through this platform, they are lending money directly to the government without any intermediary in the chain. Because there is no intermediary, there is no requirement for FDIC or NCUA insurance, as the only counterparty risk is the federal government itself. This structure ensures that the assets are not subject to bank holidays, institutional runs, or the freezing of private payment rails. During the banking disruptions of March 2023 involving Silicon Valley Bank and Signature Bank, those holding short-term T-bills on Treasury Direct experienced no disruption. The 1929 strategy proves that when systemic risk is elevated, searching for a safer bank is often a secondary concern compared to exiting the banking system entirely. Resilience is further enhanced by understanding the nuances of physical currency during periods of extreme market stress. The Great Depression demonstrated that not all physical cash is equal in terms of utility during a bank run or regional disruption. Historical accounts from the Library of Congress highlight that individuals holding large denomination bills often found them impossible to use when banks were closed. Small bills, including ones, fives, and tenths, allowed for continued transactions when merchants could no longer provide change or accept checks. Modern financial planning often ignores physical cash due to its lack of yield and the impact of inflation over time. However, maintaining a 30-day supply of small denomination bills outside the banking system serves as a zero counterparty risk continuity layer. This is not a speculative investment but an insurance position designed to bridge the gap during cyber attacks or temporary payment infrastructure failures. A comprehensive resilience strategy in 2026 involves layering 4 distinct structural levels of capital storage. The first layer consists of operating cash held in an FDIC-insured commercial bank for daily utility and transactions. The second layer involves secondary reserves held in an NCUA-insured credit union to provide redundancy through a different regulatory pool. The third layer utilizes short-duration Treasury securities held directly on Treasury Direct to achieve complete structural separation from the banking system. The fourth layer is the offline possession of physical cash in mixed small denominations to ensure transaction continuity during digital disruptions. This architecture is designed for preservation rather than yield optimization, acknowledging that insurance and investment are two different disciplines. It is a common misconception that bank failures occur as sudden, overnight events without warning. The forensic record of 1929 shows that banks often failed in slow motion, quietly reducing their cash reserves for months before the final closure. While modern internal reserve data is not always transparent, the FDIC publishes quarterly call reports detailing capital ratios and delinquency rates. The risk often materializes not during normal economic periods, but when multiple institutions are stressed simultaneously, taxing the available insurance funds. In 1933, the national bank holiday froze all deposits for 8 days, leaving those 100% dependent on bank accounts without access to capital. The mechanisms that triggered such events, including contagion and the need to slow withdrawal velocity, remain present in the modern financial system. A bank deposit is fundamentally a liability of the bank, meaning the depositor's asset is dependent on the institution's ability to meet its obligations. By contrast, a direct claim against the government represents a fundamentally different level of the financial hierarchy. The people who successfully navigated the 1929 crisis acted upon these structural truths before the crisis reached its peak. By the time lines formed outside of banks and withdrawal limits were imposed, the window for moving capital to safer structures had already closed. True financial resilience requires an understanding of these underlying structures rather than a reliance on the superficial appearance of account balances. According to the editor's opinion, the historical success of the postal savings system and its modern successor, Treasury Direct, highlights a fundamental tension between government-backed security and private banking profit. The fact that such a robust, government-guaranteed system was lobbied out of existence in the mid-20th century suggests that the safety of the average depositor is often secondary to the health of the commercial banking industry. In an era of increasing digital vulnerability and systemic interconnectedness, the strategy of structural separation is no longer a niche historical curiosity, but a necessary framework for personal financial sovereignty. The reliance on a single insurance pool like the FDIC, while generally effective, creates a single point of failure that the 1929 survivors wisely avoided by diversifying into government direct assets. Ultimately, the most valuable lesson from 1929 is that the legal and institutional pipes through which money flows are just as important as the amount of money itself.